Hello, everyone, and welcome to our webinar. My name is Avi Krawitz. I want to thank you all for joining us for our quarterly webinar series that we've been doing now for, I think, about 2 years. I think this might be our 8th Diamond Trends webinar that we've done on a quarterly basis. So I know that there's a lot of webinar fatigue out there, a lot of presentations online over the last 6 months. So I certainly appreciate you joining us and giving us your time. And I hope I can add some value to your understanding of the market and provide some food for thought, let's say. Before we get started, I do want to just make a disclaimer, because I'm giving out, I'm going to be presenting a lot of trends in terms of supply and demand and pricing in the diamond industry. But you should be careful not to use this information in your trading, that if you are trading in diamonds, that you should really do your own homework and use this information as background, as I said, sort of food for thought about what's going on in the wider macroeconomic environment that affects the diamond industry. I also want to thank Shimon Gerstensang, who is our head of trading at Rapport, who always helps me provide insights to the data that we have on RapNet and that we use for these presentations. And also want to thank our news team, Joshua Friedman and Leah Marovich, who through our discussions also help to develop a lot of the trends that we'll be presenting in this webinar. Okay, so what we want to do over the next hour or so, and I hope to leave some time for questions as well. And if you have any questions, please put them in the Q&A section of the Zoom application. But basically, we want to present. We want to give a recap of what's happening in the diamond market, what's happened in the third quarter that we've just finished. What factors are driving the industry and influencing the price trends that we've noticed in our indices and in our data. We want to understand. We did an exercise in our news team and in the Rapport group itself. But in our news team, we thought, if the diamond industry was a company, what would be the strengths, weaknesses, opportunities, and threats that company faces? And so what is that SWOT analysis look like for the diamond industry at this moment? And so I'm going to present some of the findings that we came up with as a news team and as an organization. And then I'm going to provide, it's less of an outlook for 2020 and the holiday season, but more about what should we be looking out for? And there is a difference, but let's see how the discussion progresses. So let's get to it, and I'm going to go quite quickly through it. So bear with me, and there are going to be a lot of graphs, especially in the first half of the presentation. So for all you data junkies out there, you're in for a treat. But when we look at the market in 2020, it's been such a crazy and volatile year, and long year, but there have been clear trends that have evolved in various periods of the market, in dealing with the COVID situation. And so when we think back to the first quarter, and when we think of the fourth quarter, let's say, it's important to put it in the context of the market, of how the market has developed. So when we think back to the beginning of the year started with strong rough buying. We had just come out of a positive holiday season, and manufacturers were gearing for a strong replenishment of stock, and so there was a lot of rough that came to the market in January and February, and then, as we know, COVID reared its head first in China, and at the beginning of the year, we really saw that reaction within the market to COVID in China. De Beers gave flexibility on certain categories of rough that are popular in the Chinese market. The trade exerted caution about, there was concern about payments from the Chinese market and delivery of goods to China at that time. But then the pandemic, it became a pandemic, and COVID spread globally, and we realized very quickly that that the whole market is affected by the pandemic, and the diamond market really shut down around March, and that was across all sectors, from the mining to manufacturing, wholesale and dealer, and the retail market. Towards the end of March, the US government passed its stimulus bill, the Payment Protection Program, that injected some liquidity to help small businesses and help consumers, and that had an impact on the market, and sort of gave some protection to small mom and pops, both in the wholesale and retail markets, in the short term at least. When we moved into the second quarter, we saw this rush to digital. We saw that we realized that there was nowhere to go, and except online. And so so certainly in the wholesale, in the dealer market, we saw a lot of movement, obviously, as everyone knows, on RapNet and other competing platforms popping up. Get Diamonds had a lot of success in bringing people to its platform, for example. And so there was a rush to digital in the midstream. And we also at the same time then started to see China opening up, the Chinese retail opening up again. And what happened in China, as we've seen throughout this pandemic, the rest of the world sort of followed a month or two or three later. So through the second quarter, there was a very cautious reopening of business and business activity, although that period was really the depths of the slowdown, I would say. At that time, there were enough goods in the market to satisfy demand in the short term, and so India responded with freezing its rough imports. So there was a collective effort in India to voluntarily stop importing rough to that very important manufacturing sector. And so there were no new goods being manufactured, which helped. And as markets slowly and very cautiously started to reopen, there was some gradual improvement in demand and trading activity, albeit at very low levels. We saw that start to pick up in the third quarter. That as in July, August, certainly there were shortages starting to become apparent in certain categories of polished that were supporting prices, and we saw an improvement in polished prices in many categories, and that was very much a supply shortage issue, that some manufacturers had reduced their inventories, and that was helping to prop up pricing. At the same time, through August, September, we've started to see some improvement in orders that retailers have opened up and adjusted or acclimating to the new normal of doing business with consumers in the COVID economy. That's through remote, through with social distancing, with hygiene measures in place, etc., and very much online as well. And so we've seen some orders come to the market for polished again, and that's also helped to prop up prices to some extent, particularly given the shortages in supply. At the same time as manufacturers then came back to the market to fill those shortages and look for rough, and they needed rough to restart their manufacturing activity. De Beers and Alrosa reduced prices in August and September by about 5 to 10%, and that spurred rough sales in the third quarter. So there was definitely an improvement in sentiment and activity, although it's important to put it in context that it's still at low levels when in the historic sense. It's important to recognize that around in the last month or so, there's also been a second wave of lockdowns. You know, the spike in infection rate of COVID has been up and down all along, and there's been a gradual increase. So we've had second and third waves, but it reached points in various centers where the hospitals were not able to cope, and so businesses had to shut, or activity in general, economic activity had to shut down again. We saw that here in Israel, and we're seeing it now as in Europe, that there's a spike in cases that has forced governments to impose restrictions again. And that's really where we are at the moment. So when we have a question mark about what's happening in the fourth quarter, that brings us to our present time. And again, I think it's important to put it in the context of COVID. You know, that's the number of daily new cases globally continues to rise. There are still, according to Worldometer, that I got this information from, there's still over 9 million active cases of COVID. We've had 1.1 million deaths globally. And I think it's important to put that in perspective and in terms of what's important. And certainly our hearts go out to everyone who's been affected on a personal level by the virus. So that's where we are, and that's reason for caution. You know, that it's by no means behind us, and I think there is a realization that the pandemic is going to be around for a long time. And what we are seeing is there is an improvement in understanding how to do business within this environment, and that's only going to improve, I think, through 2021. That we'll be able to manage within the crisis in a more effective way than we have in the early stages. So that's certainly true, I think, in October, as we've seen an improvement in the rough market. You know, actually, it's interesting in the rough market. There are kind of two things that have happened. The one is that we are seeing we're seeing continued momentum of that strong demand, particularly at the tenders. I think that there is a continued demand for rough and fresh goods coming into the market. At the same time, Alrosa has combined its November and October sales, so they effectively cancelled their October sale, and that sort of signals to me a continued responsible attitude amongst the mining companies to the rough market, that there is that they are sensitive to not flooding the market with too much rough as we move forward in this cautionary environment. So that's a positive. In the polished market, those scarcities continue to support polished prices, but there are more goods that are starting to come to the market, and the increases that we've seen in polished prices have sort of flattened over the last week or two, and we'll see that in the graphs that follow. The manufacturing sector in Surat is operating, but they're operating at lower capacity. And they are expecting to take a shorter Diwali break. Diwali, usually there's a rush to get all their manufacturing done for the holiday season before Diwali, and then manufacturing sort of takes a 2 to 3 week vacation. This year, because of the circumstances and the inability to do the business previously, there is an expectation that manufacturers will operate during, they'll have a shorter Diwali break. And then on the polished side, we've also seen a spike in online searches, and we'll talk about a bit more about that in later on in the presentation. Just going quickly through the retail themes that we picked up in October. We're seeing a positive momentum in China. Have had very positive reports from Tiffany, from Chow Tai Fook, from LVMH, who are all said that they're seeing positive year-on-year growth in China, in mainland China, and that means it's better than last year for this period, and that's very, very encouraging for the industry. At the same time, there's a continued weakness in Hong Kong, and we expect that will be a story that continues next year. And the US is slowly improving. It's by no means at pre-COVID levels, but as I said, there is an acclimation to, you know, there is more retailers are becoming more the ease of doing business, or their ability to do business is improved, and they're willing to do that, and they also improve. And so you are seeing some jewelers buy for inventory again, but mainly their approach to building their own inventory is quite cautious, and there are various factors that are feeding into that, both the COVID situation and the need for less goods, but also that shift to online selling, that as an online retailer, you need fewer goods to show than when you have to fill 3 or 4 locations, retail locations. So there is a need for less inventory, but they are looking for goods. E-commerce is essential, and we're seeing retailers invest in e-commerce more and more. We saw a very interesting announcement by Signet, for example, showing what the measures that they're taking to facilitate remote selling over the holiday season. And very importantly, we're seeing an early start to the holiday season, that retailers are trying to make it a longer season, because firstly, they want to avoid overcrowding by last minute shoppers. You know, come Black Friday, we don't want to see those crowds of people on you know, outside Walmart on Black Friday, and that's not going to happen. But also they're extending the holiday season because there are concerns about delivery, that with the spike in online selling, companies, you know, it might put pressure on companies like FedEx and UPS to deliver the goods in time for the holiday season. So those are all factors that are taken into account in the retail market. So those are basically the themes that are sort of shaping our news and shaping our industry in October at the beginning of the 4th quarter. And so looking at pricing, we see some interesting graphs in our RAPI index, which it's kind of our flagship price indicator. And we've seen that, you know, so this is showing from the beginning of the year, that the black line is the 1 carat, is that we've seen a gradual increase in the RAPI index since the beginning of April, since we went down in prices at the end of March, really. And there's been a gradual improvement in the pricing environment, and that continues today through in October. In the 50s, we've seen a very sharp increase in improvement and recovery in the 50 pointers, in the half caraters, and similarly in the 30 pointers. In the 50s and 30s, there has been a bit of a decline in October that we'll again maybe hope to shed some light on, or understanding on that in the slides to come. But that momentum seems to have slowed a little bit in October. When we look at on a quarterly basis, the 3rd quarter showed strong increases, and I think it's important. Strong increases, and again, it's a you know, for all those factors that we mentioned earlier, there's shortages that are supporting the market, and also an improvement in demand from the very low levels. So that's a good combination, you know, rising demand and scarcity is going to support prices. Obviously, we're talking about averages here, and I would say that it's important to note that the RAPI index is built around the top 25, an average of the top 25 categories of diamonds. So we're talking about D to H color, IF to VS clarity goods, and it's also based only on non-fluorescent goods. So we're not including here the faint, medium, and lower fluorescent goods. So it's a top sort of best quality average of the best quality goods. But we've seen kind of similar trends in other categories. When we look at the average 10% on RapNet of lower colored goods. There has, and this graph is from the beginning of 2019. I should have prepared it for just this year, but it does show that the lower color goods, I2L, IFVS goods, have been fairly weak throughout 2019, and they came down when COVID spread in China initially, and we've seen sort of the market in 2020 being supported, and there has been some improvement in these goods as well, albeit not at the same level of those D2H colors. But there has been, particularly in the third quarter, some recovery in pricing of these goods, and that has tapered off again in the sort of September October period. So it's while the market has segmented to different categories of goods, there has been some positivity, positive trend, at least in that third quarter, on other categories as well. And here's this gives a comparison of those of D2H IFVS versus I2L IFVS. So it's the higher colors versus the lower colors for 1 carats, and we see how the market sort of segmented in at the depth of the COVID crisis at the beginning of April. That throughout the year they actually followed a fairly similar trend, but the recovery has been far stronger in the higher color goods. And that's a similar type of story on the 50 pointers, although that segmentation started earlier, and that may be a China story, because China started to deal with COVID earlier. When we think back to 2019, we saw 2019 wasn't a great year, particularly for the Chinese market, and there was very cautious demand in China because of there was a trade war and various other factors that were affecting the market. And the 50 pointers and the 30 pointers are categories that the Chinese market influences more, because they are sort of popular categories in those in that market. And so we saw an improvement in the Chinese market towards the end of 2019, and that's likely what this increase here is. But as COVID started to spread in early January, the market did peak, and we saw the reduction, and then that similar sort of uptick in the better colors and better recovery in the higher color goods. And it's the same sort of story in the 30 pointers here. When we talk about the RAPI index, so it's the higher colors, the D2H IFVS range, there's further segmentation within that, and so some categories have had a stronger weight and recovery within that segment of the market as well. And very interesting, this year we've seen a fairly strong recovery in the DIF category, and this as we see in this graph, that has sort of pulled the RAPI index up a bit higher than it would have otherwise, and it's something we're looking into, and we kind of brewing. We've got a few theories brewing in our editorial department, and we're looking into a story and trying to understand what has motivated that improvement in DIF goods, and so that the one thing one thing that we're looking into is that there seems to have been this investment demand for physical diamonds during the COVID-19 period, and that has spurred or lifted prices of this category. And I will put one caveat in this graph, is that we have seen a softening of DIFs in the last week or two. Anecdotally, that's something we're hearing in the market, and we're seeing it also in the RAPI index for 30 pointers in the blue line and 50 pointers as well. That the trend has not necessarily carried on in October, but certainly between April and say towards the end of September, there's been a very strong surge in the index for D color IF clarity goods. Those are the top makes of diamonds. And so, as I said, we're kind of toying with this idea that there has been an investment demand that has surfaced during the COVID crisis. It's interesting to note that that prices are actually historically quite low. And when we look at the price list, when we dropped prices in towards the end of March for 1 carat DIF, we dropped it to the level was at 100. Well, it shows 167 as an index, but it means it's $16,700 per carat for these goods, and that was on the 20th of March. That price list, and that was its lowest point since 1999, which is quite startling. It's a 20-year low, and so possibly, people recognized that low point and started to market these goods to the investment community. But again, it's something we need to verify. I mean, we saw a similar sort of historical low in the 50 pointers and 30 points. In the 50 pointers, it hit its lowest point since 1987, which is pre-bar mitzvah for me, and it's quite a long time. So I looked very different and had a mop of hair, believe it or not. But it signals to the market that we hit a low point, and we have, as a result of both that increased demand for these goods and the scarcities that are in the market, seen a recovery, and that sort of motivated us to that the list should reflect that improvement, and that increase was also evident in the 1 carat. So what is driving the increase in general in the market? Moving away from the DIFs, but what is driving that increase? And so whenever we talk about pricing, we talk about supply and demand. And Martin Rappaport, our chairman, gave a very detailed and important, I think, explanation of the supply-demand dynamic from an economic point of view in his last webinar, and he's going to be giving a repeat viewing of that webinar tomorrow. And I would encourage everyone to register for that, where he talks about what happens when supply drops, or demand drops, or the opposite when they move along those curves, and how pricing sort of is influenced by those factors. But we do see these factors playing a role in the last quarter, and so we see that on RapNet, and this graph is a graph that we present in our monthly research report that is available to subscribers, and it shows the average time that it takes for a category of diamonds to move off of RapNet. So diamonds that were put on RapNet in June, how long does it take them to leave the website, leave the trading platform? And they can leave for various reasons. As we saw in March, that a company might leave RapNet, but generally under normal market conditions, we see this as a stone that's taken off of RapNet as a indication that a trade has been made, and so very encouragingly, we see in the 1 carat, in the higher colors, D to H across the board, and that's that the proportion of new goods on RapNet left RapNet quicker than they did a year ago, and that's very encouraging for the market. It's a signal that there is activity going on. There's a different story in the lower colors, which again sort of supports that previous graph where we saw the segmentation of pricing trends. That from the lower colors, I to K, 44% of goods that were put on RapNet in in June were removed or left the site within 3 months, whereas last year it was 66%. In the VS goods, lower color, it's 55% versus 70% last year. The trend is positive on the higher goods, and so that's a signal that there is improving demand that there is more demand in the market. Doesn't mean that more goods sold in those 3 months compared to last year. It just means that the proportion of new goods that are available are being consumed, or a higher proportion of new goods that are available are being consumed, and that's a good sign for the market. Another signal of increasing demand or interest in diamonds is the number of searches that we're seeing on RapNet, that we've seen since April, as more companies return to RapNet. As you know, there is that context to put it in, that a lot of companies left initially when COVID struck, but a lot of companies have come back as well, and many companies have come back. And we're seeing a continued increase in searches done on RapNet. So that's buyers who are looking for goods among suppliers. So that could tell us, that tells us that there is increasing demand. It also tells us that the market has changed, that there is a pivot to digital. You know, a lot of those searches might have been within the Boursa, you know, that people aren't physically seeing each other. They're not traveling to Belgium or Israel or Mumbai or Hong Kong to buy goods and search for goods in a physical way, and so they're left to do the bulk of their research online. But it is a sign of a market that is becoming more active as we move along and as we head towards the holiday season. And so that's a sign of increasing demand, I think. From the supply side, and so with increasing demand, that gives pricing some impetus and some weight. Okay, so from a supply side, we saw how supply dropped dramatically in the second quarter when COVID hit, and this that's evident in the value and volume of rough imports to India, which India being the center that manufactures a vast majority of diamonds in the market. And so that dropped significantly in the second quarter, but the rough market did rebound a bit rebounded in September, certainly not to pre-COVID levels. The improvement, I think, will continue in terms of rough imports to India, because there is a bit of a delay. So all that rough that was sold by De Beers and Alrosa, a lot of that I think will come to India in October. So we will continue to see the increase, but we see how the supply has reduced in this graph, and that's also evident in the goods that are coming out of India. The polish that has come back that has come out of the manufacturing sector dropped significantly in the second quarter. It rebounded somewhat in the third quarter, and we'll see where we're at, but it's certainly not at pre-COVID levels. And so that supply story continues to influence prices, and the shortage of the storyline of shortages being evident in the market. But we are seeing that a gradual increase in production and new polish that will come to the market when you consider the rough that was sold in August, September, October. Okay, so I'll go through these quickly because we are going to be tight on time. But that interplay between inventory levels and pricing, we've shown in the past. We do present this slide with caution, given that inventory on RapNet has been volatile in 2020. But we have seen, I do think that this increase that we're seeing of inventory that's available in the market of these 1 carat DH IFVS goods is a reflection of what's out there. There may be much more goods in the market, but it's the uptrend that's important to us at this point for our purposes. So the increase, I think, is reflective of the market, and so as more goods have come to the market, the 1 carat is, in truth, have been fairly stable through September and October. So the question is, if this orange line continues to uptrend, what effect will that have? Maybe there might be a bit of a lag in the effect on 1 carat pricing in this graph, because we have seen that prices continue to be fairly firm for the 1 caraters at the moment. Well, not similarly, it's more apparent, I think, in the 30 pointers that as the blue line here is the inventory. Sorry, so as inventory increases, we've seen that that polished prices, our RAPI index has softened, and that's kind of how that interplay, one would expect that to play out. So those are that's a little shtick on pricing. Before I get to that SWOT analysis, which I think that I really want to go through with everyone, I think it's worth pausing and just considering the rough market at the moment, and from a rough production point of view, because I think we talk about the changes that have been accelerated on all levels of the diamond industry, that are going to be sustained in the long term. I would expect, this pivot to digital is going to be a long-term trend that's going to continue post-COVID. But I think the changes that are happening now in the rough market are really fundamental, and were A, required, and B, are going to have an important effect on how the market operates in the future post-COVID. Firstly, we have to recognize that the mining companies are holding a lot of rough. That and that's what the graph shows. This graph shows our rough inventory index, which basically shows the production over sales volume as an index. So it's a collection of production and sales volume data from 6 major companies that we have the data available on a consistent basis. So that's De Beers, Alrosa, not Rio Tinto, they don't give sales volume data. So it's De Beers, Alrosa, Petra Diamonds, Gem Diamonds, Lucara, Mountain Province. I don't know if I've left one out, but anyway. So if we take production over sales volume -1, a positive number means that the mining companies are building inventory, that they've produced more than they've sold. And a negative number would say that they've reduced inventory, they've sold more than they produced. And we see in the second quarter how, to what extent they produced more than they sold, and that the index was at about 4.8. Whereas it's usually it's usually a decimal point, so it's a good 5 times the amount of production that became available or remained unsold in the market in the second quarter. And we don't have the third quarter data yet, because the mining companies are still, tomorrow we expect De Beers data. The data is not all out there, but we do expect that positive number again. I don't think it'll be quite as high as this, given the volume that was sold to the market in August, September. But I do expect it to be positive, and the mining companies are holding a lot of rough. And so that inflated inventory at the mining level will challenge rough values, the value of rough diamonds in 2021, I'm quite certain of it. And the policy that the mining companies have been able to implement of price over volume will be challenged. I don't think they'll be able to sustain that, and it'll take a very cautious approach to bringing all that rough inventory to the market. I do think that there will be some rough corrections as a result in 2021, but we'll have to wait and see. I also expect that the mining companies will lower their production guidances or their plans for production in 2021. We don't have a plan yet, but I think you'll see that production plan for 2021 will reduce quite significantly compared to this year and compared to last year. I think there is consolidation in the market. It's not necessarily mergers, but there are smaller players that are dropping out of the mining sector. And so the likes of the bigger players like De Beers and Alrosa are gaining some market share. And there is sort of they're gaining market share, but the smaller junior companies and mines that are sort of standalone assets within a corporation are being challenged, and many are not surviving. And so that'll continue to play out. And finally, and probably most importantly from a trade point of view, is that there's a change in how to sell rough that's taking place this year that's going to be sustained in the future. You know, that the fact that people can now buy a site without going to Botswana or buy from Alrosa contract sale on a monthly basis without traveling to Moscow is significant. And I think that's going to continue, that De Beers and Alrosa and others have been able to sell rough, volumes of rough digitally, enabling viewing on a digital platform has been significant for the market. And I think we're going to see more of that, especially among the smaller players, you know, the likes of Lucara and with their Clara platform. These are sort of trends that are going to only accelerate and continue after COVID. So I think it's just worth noting that about the mining sector and the rough market in general. 2021 is going to be a very important year, I think, in the rough market dynamic. And I'm looking forward as an analyst or a journalist. It's kind of fun and interesting to observe. That's my privilege. I don't have to buy, but anyway, at this stage, we see that the industry is kind of at a crossroads. You know, when we think about, you know, what's going to happen with rough supply post-COVID and how is the market going to evolve? What changes that have taken place in 2020 are going to be sustained, and to what level are they going to be sustained? There's kind of a feeling, especially ahead of the holiday season, that the industry is at a crossroads. And so it's an interesting exercise, I think, to consider, you know, we always ask the question, if we could build a diamond industry from scratch, how would we approach it? And the result would probably be very different to the way the diamond industry has operated in the last decade. And it's probably more towards the way the diamond industry is trying to steer its way towards in 2020, excuse me. And so that comes through when we consider the strengths, the weaknesses, the opportunities and threats that the industry is facing at the moment. And some of those, you know, I think it's important to know. I had a conversation with Yoram Dvash, who is the chairman, the president of the World Federation of Diamond Bourses, and he made the point that, you know, the industry, it's not a private company, and so everyone's coming to the market with different perspectives, with different goals, with different opinions, and different approaches, which is part of. I think that's a strength. But it's kind of maybe unfair to do this exercise. But let's do it anyway, and I think it does give some perspective to where the market is holding at the moment. So when we consider the strengths of the diamond industry, and this whole discussion came out of a brainstorming session we had in our news team, and I really encourage you, if there's anything I leave out on any of the factors, to let me know, and let's make this a conversation. I am planning to write this up as a report that would be available on the research report that we put out on a monthly basis. So I'd love to hear from your feedback. But if you think of the strengths, we divided into like sort of 3 categories. That there's the product, there's the marketing prowess of the diamond industry, and the industry structure itself. You know, from a product point of view, it's a desirable product. You know, people want it. People are drawn towards diamond, and it holds value, and it's rare. And we've kind of seen that in the last 6 months. You know, that DIF sort of story is kind of, it reinforces the rarity and the value that a diamond holds. The other thing is that it's a natural and authentic product. You know, I don't want this to sound like an infomercial, and I'm not a marketer, but in today's world, people are, you know, the younger generation is drawn towards authenticity, and the diamond, in the natural diamond product has that. It has that romance and authenticity about it, naturally, that it brings to the table naturally, you know, and that's very powerful. From a marketing point of view, the industry has a very powerful story to tell, considering all those aspects of the product: the desirable value, the rarity, the preciousness of the product. That it makes for a very appealing story, and very good story. And along with that, it has a unique ability as a product to create an emotional connection. I mean, we talk about it so much within the trade, but that we sometimes start to think quite skeptically about it. But it's true that the emotion that a diamond brings out, and what it represents, is very powerful. We have a very strong marketing legacy. You know, when you consider the place that diamonds hold in pop culture. You know, the diamond is forever. The diamond is forever slogan, and that it's just automatically known by people, and that it's the go-to sort of product for an engagement ring. You know, diamonds are a girl's best friends. All these things may sound like cliches to us who write headlines every day, but they're important to the marketing legacy that we can build on as an industry. And finally, it's from a marketing point of view, it's just kind of made for social media. You know, it's visually attractive. Diamond jewelry is visually attractive. It's a product that friends want to show friends, and they want to get that like. You know, and they want to share it with their circle and beyond. So it's really, from a marketing point of view, it really is a powerful product that's positioned well for this social media economy. From an industry point of view, this surprised me in our discussion, because I didn't actually think about it before. But the diamond industry has a very strong sort of structure to it. You know, that the leading companies are very strong companies. The De Beers, the Alrosas, the Tiffany, Chow Tai Fook, Signet, you know, the brand Cartier brands, for example. These are all part of strong companies that have strong brand recognition, and create a good structure for the market. It creates scope in the market. You know, we'll get to the weaknesses later, but one of the weaknesses is that it's also a fragmented market. You know, the midstream is primarily family-owned small businesses that might not have certain corporate structures in mind. But those strong leading companies have really had an influence on bringing a responsible business practice to a trade that didn't always have that reputation, and so that's a good thing. I think it's important to recognize that we have a very vibrant dealer market, and the dealer market is, you know, I think it's vulnerable at this moment because of COVID, and we're not able to see that activity on a diamond trading floor, at a trade show, etc. But when the market recovers, we really want the dealer market to come back, because that interaction between dealers really creates value for the diamond industry, and that's something to recognize and to build on, and to celebrate. The final thing I'll just mention amongst the strengths is that the diamond industry in the midstream, the manufacturing and the mining sectors too, is quite tech savvy. You know, that it surprises people to hear this, that in the last decade, the industry has really been an early adapter to technology. When you think about the manufacturing that takes place, the ability to plan your cutting process, the ability in the mining sector as well. When you think about the Lesedi Lorona, a stone above 1,000 carats, and others that have been mined in the last few years. That wouldn't have happened with the new technology that's been adopted in the mining sector. So it's a strength within the mining and manufacturing sector, the tech savviness of those sectors. Retail might be a bit of a different story, and we'll discuss that in a bit. Among its weaknesses, we divided this into four categories really, and the profile of the industry, reputation, branding, and supply inefficiencies. In terms of profile, when you go to to a diamond conference or a WFDB meeting or whatever it is, the participants look very much like this guy in the picture over here, as handsome as he is. But it's not a very diverse sort of environment. And so there is a lack of diversity within the trade. The trade we need to see more women. We need to see more people of color in the trade and in the industry at large. And we need to see a younger generation as well being more involved. And we are seeing younger diamantaires come into the market. There's a wonderful organization within the structure of the WFDB that's over the last year or two has really become very active, the Young Diamantaires group of the WFDB, and that should be encouraged and brought into into more sort of leadership roles within the industry. And I think the WFDB should be commended for developing that group. But certainly there's more that needs to be done. Beyond COVID, the issue of diversity within companies, within industries, is the hot button issue for 2020, and the diamond industry needs to be aware of that. I would say that at retail, we are seeing more diversity, certainly in terms of the gender profile. More women are involved at retail, and there probably can be more work to bring more women on board at an executive level. But there are encouraging signs. I will say that while we're discussing weaknesses, a lot of these are historic, and a lot of them are being addressed now, which is very, very good. It's a very encouraging and positive thing, and reason for optimism. But it's important to recognize them anyway. In terms of reputation, there's a legacy within the diamond industry. I still have to tell my friends about, explain that, not all diamonds are conflict diamonds, that there is this trend to, there's a concerted effort towards responsible sourcing within the industry, and there is a perception about the environmental impact of the trade, and certainly from a marketing point of view, we've faced that accusation from the lab-grown market, for example, although they've kind of stopped lately. And so there is a perception about diamonds that still exists today, and that requires us to change the mindset of consumers who might consider that, and that's an education program that would require everyone to be involved in. In terms of branding, the diamond industry needs more brands. There's a lack of brands in the market, and more brands means better competition, means better storytelling for the industry as a whole. Ultimately, it's still a fragmented family business, and when it comes to family businesses, that means that the majority of businesses are involved in selling and not necessarily marketing. The marketing is left to the bigger brands to engage in, and so that has been a weakness for the industry, I think. The lack of branding sort of has stifled the industry in adopting new sales mechanisms. That's what's been so enlightening about 2020 and the COVID situation, is that suddenly people are able to sell online, and that wasn't always the case. There was this mental block until through to last year, that you couldn't really effectively sell diamond jewelry en masse in an appealing and effective way online, and that's not true, as we've learned this year. From the supply side, and in terms of the supply chain, it's not necessarily the supply side. The market's not the most efficient market. There's certainly a lack of, the lack of midstream profitability has been the theme of these webinars for the last 2 years, and that needs to be addressed. I think it is being addressed at this moment, given the supply dynamic in COVID. But it will need to continue, and we need to ensure that there's profit in the game for everyone. And similarly, with that imbalance of supply, we don't want to be in a situation where the midstream is stuck with the volume of goods that it was through 2017 to 2019, because that has a depressed impact on the market, on polished pricing, and on sentiment in general. The market is very reliant on credit. The way rough buying is, relies on credit. The manufacturers have to pay for rough in cash, and they sell on credit. So the industry sort of needs to reduce its reliance on credit. And in terms of the way, the journey of the diamond, the interchange and the transportability of the product, there is also, I guess it's more of a reputation issue, but it's also still very real that the product and the industry is vulnerable to issues such as tax evasion and money laundering, round tripping, etc. And that while it may not necessarily, to whatever level it's at, it makes authorities clamp down on the industry and have a negative perception about the market as a result of that. Okay, in terms of threats, and I'll deal with threats before opportunities so we can end on a positive, but the threats are fairly obvious. Economic recession we've experienced this year. Synthetics is a threat. The growth of synthetics we've seen in 2020, there's been a more greater acceptance within the wider industry. We see for lab-grown diamonds. We're seeing more retailers selling lab-grown. We're seeing more manufacturers being involved in the market. And but that said, it's still a product that is being marketed as a competitor to the natural diamond industry, and so it should be considered a threat that can eat into our market share. Other luxury products, be it electronics, handbags, you name it, that anything that a couple might choose to spend their discretionary budget on rather than diamond jewelry is a competing product and a threat, and that includes the experience economy that the diamond and jewelry industry has been kind of slow to tap into, and really it shouldn't, because it's a product that encompasses experience. It's an experience to receive a diamond, for a woman to receive a diamond ring, and for a man to give it. So the issue of traceability I put as a threat, but it's also an opportunity, as we'll see, because it's a threat because many people, I think, are concerned, or many people have told me that the mom and pop, the individual diamantaire, the dealer out there is concerned that they won't be able to provide that traceability to the same extent that a bigger company or the bigger brands are able to, and they're concerned that it might be an added expense. They're concerned that they won't be able to gain a premium by selling the traceability story. So there are a lot of concerns about this, but as I said, it's also listed in the opportunities, and we'll get to that. Another threat is the declining marriage rate. That's it's an industry that relies heavily on the engagement ring market, but people's attitudes towards marriage have changed, and people are committing in a different way. So that's something that we need to adapt to. It doesn't mean that they're not together. It's just that we need to tap into those moments that express that commitment, whereas before it was much easier at that proposal moment. It might not necessarily be there as prominently as it used to be. And then finally, among the threats, there's the growing alternatives to diamond engagement rings. Lab grown might be one of them. A couple choosing to travel instead of buying an engagement ring might be another. The colored gemstone market is very adaptable to tapping into that sense of uniqueness that color might represent for a bride to be. But I think also that obviously every diamond is unique and different, so that also feeds into that. But there are alternatives to that engagement ring market, and we need to focus on that bridal sector to ensure that we still control it and we still have our that's our bread and butter. In terms of opportunities, and I know we've reached the hour mark, so I appreciate you all sticking around. I am going to, we should make this video available online after in the coming week or so, but I just have a few more slides to get through, and then we'll hopefully take some questions if you have any. But the opportunities they're long-term opportunities that have evolved over the last few years, and they're also those opportunities that have surfaced during COVID-19. Among those, there has been a shift in discretionary spend in 2020. There is an opportunity to take advantage of that limited travel. Whereas if people would usually travel over the holiday season and spend a chunk of their discretionary budget on travel, they won't do that to the same extent this year. And so for the holiday season, that is an opportunity. People are reassessing their choices, and they are looking to express that commitment in a meaningful way during this period of uncertainty. And so again, that's an opportunity that COVID has given the diamond industry, because it's a product that ticks that box, and it's a product that really expresses that emotion. That acceleration of digital is something we've spoken about, and continues to be an opportunity for now that we've come on board. We need to stay ahead of the game in that digital economy, and really look at the next step and the next step, and not rest on our laurels. There's a marketing initiative that has, by whether coincidence or not, during COVID, but the Natural Diamond Council has developed a very exciting generic marketing campaign for the diamond industry, and that's an opportunity that we've been waiting for so long, and we need to take advantage of it, and we need to get on board with it, and I'll speak about that in the next slide. But we also need to tell our story of the impact that diamonds have on communities. Along with the COVID economy, has developed the kindness economy, that people want to see that people are doing good and people want to do good for other people, and they're looking for those values in their product, the companies that they buy from, and the industries that they engage with. And so the diamond industry has that story to tell. And we need to tell it in an effective and sensitive way, and at the same time reassess the supply chain as we pivot towards responsible sourcing, and that's where that traceability program comes in. That we need to account for our diamonds. It's something that in that kindness economy, people want those assurances, and as consumers look for authenticity, they want that assurance. And so the traceability has been a trend that's been evolving in the long term, in the last 2 to 3 to 4 to 5 years. In fact, at Rappaport, we were talking about it in 2008, and in other circles as well. But it's really come to that ability to trace a diamond back to the source of mine is now available, and that's something that enhances the diamond story, and something that the bigger brands are pushing, whether the smaller dealers and retailers like it or not, and whether consumers want it or not. It's an aspect that the big brands have recognized enhances the diamond story and enhances their ability to add value to their brand and sell their diamonds. And so it's something that I think that we're all going to need to pivot towards. I've used that word a lot, to pivot towards something. I have a lot of habits when I speak when I speak to a computer screen. Anyway, from a long-term perspective, we talk about the overhang of rough supply in the mining sector, but when you look longer term, 5 to 10 years down the line, there are a few diamond mines that were prospective diamond mines or important diamond mines before COVID that were going to prolong that shortage of rough in the market. And now, and in the COVID environment, there's some mines that are not coming back to operation. When you think about Renard, Ikati, these are mines that are in jeopardy at this stage, and hopefully they'll come back. But I think certainly the economics of developing a mine have changed as rough prices have changed. That mining companies have to consider a lower price per carat when they consider the economic viability of their mining operations. And so I think in long term that'll have an effect on supply. We'll see when we get there. As we mentioned, the other, among the long-term trends, a change in the way a rough is sold. We're seeing more online sales in rough, and more partnerships across the supply chain. A mining company partnering with the manufacturer and with the retailer to develop a special rough stone or greater volumes of supply, which is interesting. And I think we are moving towards a world of customized rough supply that mining let's say manufacturers are going to be insisting on buying according to demand, and having to buy boxes where they only need 70% of the goods and the other 30% they're stuck with. We spoke about inefficiency, about making the market more efficient, and that is something that seems to there are more efficiencies that have crept into the market during the COVID era. I think post-COVID, we're going to see more adoption of sort of automation and things like that are going to help manufacturers manufacturers and everyone across the pipeline. Miners also benefit from automation, grading companies, retailers as well, but making the market much more efficient. And so to conclude, when we consider an outlook, it's more, what are we going to look out for during the fourth quarter holiday selling season and in 2021. And I'm going to start with marketing. And as I mentioned earlier, the Natural Diamond Council, which is responsible for sort of category marketing on behalf of the diamond industry. But the industry really must support the Natural Diamond Council. Its new campaign, For Moments Like No Other, is very exciting. We've got a celebrity on board, and it's something that the trade can support, and that retailers can support as well. And they can do so by engaging with their campaigns on social media. It's a simple retweet, for example, or repost on Instagram. And there are assets available to the trade by the Diamond Council that tap into the campaign. And I think most importantly, and we spoke to David Kelly about this, and he emphasized that the council is identifying trends that the industry, if you consider the fashion industry that has a concerted effort to push certain trends on a seasonal basis, the diamond industry has never really done that, and it's kind of just been ad hoc. And so I would encourage the diamond trade to tap into the trends that the Natural Diamond Council has identified. Look at the jewelry that it's using in its adverts, and see how you can enhance, help create a momentum in those category of goods. And finally, looking at the natural diamond industry, David made a point when he started in the industry that the idea is to change the tone of marketing, and how does the industry speak to the consumer. And generally, it's been quite conservative in its messaging, particularly from the trade attitude and up. And so I would encourage everyone to note that this for moments like no other is much more feminine, much more sexy, sort of exciting and youthful tone and language, and that's something that we can all adopt in our social media, in our general marketing activities. So that's from a marketing point of view. I think we can expect, everyone's talking about a K-shaped recovery. The industry is segmenting between the haves and the have-nots. And we did a really interesting podcast with the Jewelers Board of Trade, who have noted that those companies that have adopted digital and online platforms, those retailers that are online, are managing have been able to recover in a much more effective way than those that have not. So companies with strong digital footprints, for example, are better positioned for recovery, regardless of where they are on the pipeline. So that applies to retail, polished, and the rough segments, really. And there will be, I would expect that something we're going to be looking out for is that segment, the bifurcation, is that the word, of goods that are in demand. Those higher that segmentation between the higher color and lower color goods, for example, will that continue? And what segments of the market are or what categories are in demand? I think you're going to see that's going to be a theme within the recovery. The longer term goal with effective marketing is to broaden the scope of demand, and that affects a broader range of goods that are traded within the industry. And then the supply balance, as I said, 2021 will be a crucial year for rough supply. The industry has an opportunity to ensure that there is a sustained balance between polished demand and rough supply that ensures long-term growth, both within the trade and the mining sector. Finally, we talk about positive sentiment. The sentiment is quite positive, well, is relatively positive, considering where we've been in 2020. But we cannot expect that we'll have year-on-year sales growth during the holiday season. It's unrealistic, considering the consumer market that's out there. But we can anticipate positive consumer sentiment towards diamonds. And the industry has a unique opportunity to realign and position itself for long-term growth. That will require wider trade participation in macro efforts to raise demand and continued responsible and conservative supply practices. I believe that a return to sustainable growth is well within our grasp for 2021, but it requires a united effort and really strategic thinking on the industry's behalf. So that's all I've got to say. I know there was a lot that we got through. I'm sorry I went a bit over time. I'll be happy to take questions, and you can write those in the Q&A section. I would love to hear from you. If you have any other sort of strengths, weaknesses, opportunities, or threats that you might have thought of, please email me, avi.krawitz@diamonds.net. And I'll be happy to hear from you. As I said, I am planning to write a report on that sort of analysis for the next research report, which will come out at the beginning of November. And you can subscribe to that report in the link on the screen. So let me just see if there are any questions in this. So yeah, one of our participants mentioned he's Italy-based, that that there has been a spike in cases in Italy. As I said, there is a we are seeing a renewed sort of number of cases in Europe, and that is a concern. It is a concern. What are the risks of a flood of rough by desperate miners? Are a number who desperately need revenue? It's true, you know, until, you know, so far we've seen the mining companies, particularly the majors, being very responsible, and I think it's in terms of their supply and enabling flexibility on their contract sales. You know, it's interesting that Alrosa is in negotiations to sell, you know, more than half a billion to $1 billion, I believe, worth of rough to Cochrane, to the government. And I think there are a handful of companies that have the volume of supply that's really going to affect the flooding of the market. You know, so if a smaller miner, you know, lowers their prices to an extent so that they can get rid of inventory, it's not going to affect the market. But there are companies that I would keep an eye on. You know, that companies with, you know, 3-4 million carats per year, sort of, and more, and particularly the majors. But so far, the messaging we've got from the majors, at least, is that they're quite conservative in releasing goods to the market at the moment, and that's good. So we have a question about lab grown. Is there any indication of the effect that created diamonds are having? As I said, you know, it hasn't actually been a topic this year, and that's been interesting. That and I think it's for two reasons. One is that COVID is on our minds, and so we've got a new threat to deal with. And the other is that there's more of an acceptance within the trade about that synthetics is here, and so what do we do with it? Do we, you know, that more retailers are selling lab grown, and more manufacturers that are manufacturing these goods. And so we're kind of seeing it find its place in the market, and we find the market find its place with lab grown, and so it's a growing market. You know, there is growing demand, but it's at a very small base at the moment, and as more, you know, we maintain our position that as more supply of lab grown comes to the market, it will depress, it will depress prices of lab grown and further differentiate the product with the natural diamond. You know, that as prices of lab grown comes down, we're able to say as a natural product that this is the product that, well, we can say it regardless, but the natural diamond is what holds value in the long term. Okay. So someone mentioned that they missed the first part of the webinar. We are planning to put it online, so you can catch that. The question is, the question really is the impact of the US election on the market. I don't know, to be honest. It's, you know, they talk about an election year being one of uncertainty and caution. You know, this has certainly been that. I don't know what the effect will. I don't know if they'll have an effect on the diamond markets. You know, maybe on holiday spending. You know, if you talk to Wall Street, then it seems that Wall Street favors a Trump administration. Main Street seems to favor a Biden administration. It's an age-old sort of debate. but it's certainly I think the negative sentiment about the election, I think is adding to the uncertainty in the market. That's for sure. Okay, I spoke about the way people do business as they go online more, but don't you think that that's just temporary? Our business requires travel, and it's an industry where sight of the product is critical. Look, I do think that travel, the travel aspect of the industry will return. And I think the other aspect of that is not only about seeing the good, but it's about seeing the person. That networking that takes place at a trade show. And we've sort of seen a decline in the willingness to go to trade shows. I think a lot of people missed out on JCK this year because they missed that networking. And it's a people industry, so that will, I'm quite confident that will return. In terms of the ability to sell a diamond online, though, I think that will remain. And I think our ability to do so will strengthen. And I think that's both on the rough and the polished side and the retail side. That feeds into increased transparency within the industry. You want to know, that you'll see even more information about the rough diamond, about the polished diamond, about the jewelry itself, being made available online. But I do agree that there is that physical aspect of seeing the good, particularly on those, particularly on non-certified diamonds. And when I talk about bring the dealer market back to its to vibrancy, that's what we want to see. We want to see people moving from door to door within the Bourse and showing goods. But I think that people aspect is something that's interesting, and it's we always said, if retail is, if real estate is location, then the diamond industry is connections, and at some point, part of the online sale is trusting the person behind that sale, and that is really most effectively achieved on by face to face. So I think it will return, but it will take. I don't expect a lot of travel in 2021, to be honest with you, but we'll see. Maybe I'm wrong. Is there a threat of some smaller players in the midstream folding? Yeah, it's a reality of the economic situation that I think we are going to see people fall out of the industry. Sometimes we exaggerate that expectation. For example, when you listen to that podcast that we did with Eric, I forget his last name, my apologies, Eric from the Jewelers Board of Trade. They track the number of bankruptcies or mergers in consolidation in the retail sector. And we always, throughout this year, we've expected that number to be much larger than it really is. And so we do tend to exaggerate that expectation, but I think it's natural that we would see some weaker players fall out in this environment. In view of all that you've said, what is the future of rough diamond tenders? I think that rough diamond tenders have a future, because I think that's, even more so than the De Beers and Alrosa contracted supplies, that the tender houses have been able to sell online, and they have the capabilities to show their goods to an extent online and sell through a digital platform. And so I think they're not going to, that method is not going to go anywhere. But I think I think that we are going to see more of this sort of customization of rough supply towards demand, and it'll be interesting to see how the tender houses and the mining companies who sell by tender tap into that trend. Okay, we'll take a few more. how have financiers and banks been reacting or supporting the industry since COVID started? That's a very good question, and it's an important question. The truth is that there's been more of a it's been more of a story of a lack of a reduced need for financing. So people were not buying rough for through the second and part of the third quarter, so they didn't need that financing to. So they didn't. So they were able to. So they didn't need the credit firstly, and at the same time there was some a level of support that the government, for example, in India, instructed the banks to be more lenient in demanding repayment of loans. And so, we haven't heard that same story of tight liquidity in the traditional sense, of rough prices squeezing polished and that whole dynamic, because there's been no rough buying and because the banks have been a bit more lenient on the repayment of loans during that very dark period of the second quarter, for example. And so it does, but they, having said that, there's always caution, and ABN AMRO closed one or two of its branches. I think it's mainly in Antwerp now in terms of the diamond trade, and we're still seeing that cautious attitude towards the diamond industry. At the same time, we are seeing, I think, more sort of alternative financing methods that are still brewing, and people are sort of trying their place in the market and finding their place in the market. Okay, I'll take two more questions. Let's see. Since a retailer carries the most burden of overhead and carrying cost, what do you think a retailer should do when the wholesalers are selling at retail level and online sales have seriously damaged the profitability prospects? Well, your supplier is competing with you because they're able to sell online. I actually haven't seen that much of the, and I'm not that on top of that aspect of the market, but I haven't really seen that much wholesale selling direct to the public as one might have thought. But I do think that retailers need to be confident in their place in the market. No one can sell to the consumer like a retailer, and so I would say that retailer has to be online. They have to have that omni-channel capability, and they need to think out of the box. What sort of outreach are you doing on a from a personal point of view? Are you picking up the phone to speak to a prospective client in ahead of the holiday season? How is your consumer engagement? And I don't believe that wholesalers have that same capability that that any effective retailer should have within their community. Okay, I think that's about it. So yeah, I think we've been through pretty much the other questions are more comments, and I appreciate your thanks. Thank you for joining us and sitting through the presentation. And as I said, if you have any comments or questions or additions to the thoughts that I've brought to this presentation, I'd love to hear from you. And so thank you all. We'll meet again probably in January for a recap of the fourth quarter and the holiday season in 2020. Please God, we'll have a vaccine by then. We'll all sort of be more back to normal than we would have expected. So I wish everyone a successful holiday season, a happy holiday season, and a meaningful one. And thanks again for joining us. And I look forward to hearing from you. So thanks again. Bye-bye, everyone.